All right, and that was Lloyd with his currency strength differentials. And let's get into a little bit of fundamentals to kind of tie up. So I'm really glad to say that I kind of found similar pairs to him, and I was actually looking at pound yen. But before we go to pound yen, let's take a look at what's going to be happening first up next week. Now we are entering into the end of the year, what we call the holiday season trading. So it is pretty normal for volatility to be a little bit choppy because the volume will kind of drop a little bit as traders kind of tie off the end of the month. So a couple of things to watch out for. So we have first up, I think next week, we have the official cash rate from the New Zealand side, where New Zealand, there's a high chance that there'll be a 0.25% drop. In fact, it's already forecasted a 0.25% drop in interest rate. So we might see a little bit of retracement and softness further coming into New Zealand due to the interest rate drop. All right. We also have USD unemployment claims coming on Wednesday. So this one is pretty interesting because again, into the end of the year, I think the USD has been a little bit on the softer side. Or it's perceived as a softer side, but somehow it doesn't look that way on the charts, right? On the charts, we do still see quite a little bit of bullish USD bias. And I think, as I mentioned in previous of my fundamental sessions, that what is the reason for people to actually dump USD at this point is pretty difficult, because while there is a negative sentiment due to expectations of interest rate drops in the USD, the US dollar generally does face a nice strong buy side demand because of its status as a global reserve, and also because if you are buying oil, you're buying gold, you're buying stocks, you will need to have USD on hand, right? So there is a general base demand for US dollar. So it's really, really hard to see US dollar weakening exponentially or very aggressively. The weakening of the US dollar, I normally would prefer to look at it more as a pullback, depending on whether the pullback is deep or not. All right. Now, we come up onto, I think, the Japanese CPI on Friday. Now, speaking of the Japanese yen, I think the Japanese yen has a really interesting news coming right up. Over here on CNA and also on a few other of those news portals, there is news talking about Bank of Japan maybe will hike interest rates in December. If the Bank of Japan does bump its interest rates in December, the Japanese yen will tend to strengthen a bit for maybe short period of time. But what is interesting is if CNA says it's on a knife edge, right? Knife edge meaning it's still a 50-50. So if you kind of read through several of these similar headlines, there is there is a possible intention to increase interest rates, but I do think there is higher probability that the Japanese government is trying to use the news, by releasing this news to see whether the Japanese yen will strengthen on its own based on a news reaction, a news sentiment, instead of actually changing its interest rates, because their position is a bit more reluctant to increase interest rates. So the Japanese yen in this coming next couple of weeks becomes a little bit of question mark, because when we talk about the Japanese yen, there is a little bit of weakness. It's very debt heavy. It's got the lowest yield at the moment. So I do think in terms of carry trades, especially, right? I do think that the yen pairs in general, and if you look at the yen pairs, for example, like the dollar yen over here, this is the weekly time frame. Let me pop down to the daily time frame. I think the yen pairs have a lot of potential to retrace a little bit based on the back of this news. So as you can see, the dollar yen, despite the dollar, I mean, a lot of people say the dollar is weakening, but dollar yen hasn't even weakened a little bit. It's in fact pushed past my first target of 155, almost hit 158. Previous high is around 159, and then a big retracement on Friday. I'm not too sure if this retracement is based off the news or not. It might be a technical retracement, but I find it very difficult to aggressively sell off the dollar, except short term. Short term, if you look at temporary moves of the dollar yen in terms of interest rate, the interest rate carry, right? So when we look at dollar yen, again, I always like to look at the 10-year yields. So if you look at the US dollar 10-year yields, it's over, I have it over here. Okay, over here. Now, if you look at the US dollar 10-year yields, and maybe it might be a bit cleaner if I give you guys on a dual chart over here. So we have the US dollar 10-year yields, dollar yen at the top, and let me pull it up over here. Okay, so this is let me just auto fit this too. And okay, US dollar 10-year yields versus let me see if I can line up a little bit somewhere like this, okay? So you have the dollar yen, you have the 10-year yields. Now, historically, we do have a decent correlation when it comes to the dollar yen and the US dollar 10-year government bond yields. And normally, the 10-year yields kind of front run the dollar yen. But starting from May onwards, I think this is the period where, the tariff situation kind of kicked off. You can see there's a very big divergence where the dollar yen and the 10-year yields are no longer in sync. So the question I have is, will this indicate a change somewhere over here? So this is the interesting part, right? Because if you look prior to the Trump yields, the Donald Trump tariff situation and stuff like that, when it's a bit more unstable, you can see that the chart pattern, just eyeballing it, right, is pretty correlated. But what has changed ever since then is because of the tariffs, because of the uncertainty in the interest rate market. You can see in the last 6 months, in fact, we do have a divergence of the correlation. So with the divergence of a correlation, the question I have for the market is, when will we go back into correlation? So I think coming up next, the interest rates that will be really interesting for us would be the Japanese interest rates, as well as the Fed Watch CME interest rates. So this website over here, for those of you who are new especially, is called cmegroup.com. This shows the projected interest rate expectations of the US, which is pretty interesting to kind of track, because if you kind of look at this maybe on a weekly, bi-weekly basis, or just fortnightly basis, actually, you can see that, for example, I'm looking at the 10th December probabilities, right? You have a 71% to 29% here, where interest rates will pop to 4%. So what is the current USD interest rates right now? The current USD interest rates right now, it's actually 4.25%. Actually, sorry, 4%. Okay, it's currently at 4%. So over here, and what this means is there's a 70% probability that most traders are expecting the Fed to drop at least by 0.25% over here, and then a 30% might be same, or maybe drop the interest rates by 0.25%. Now, if you had seen this probably last month, actually there's a higher probability over here. So this probability chart does change. So I think last month we were looking at this, there was like almost an 80% to 90% probability that interest rates will be cut in December. But over here, the interest rates the Fed, the probability on this Fed Watch 2 has changed. In fact, the estimation of whether or not the Fed might cut interest rates has actually dropped. So there is going to be a slightly higher probability that December, right, maybe the Fed will just hold the rates. And if the Fed does hold the rates, we should see a little bit of bullish dollar coming along, because if you're not cutting the USD, then there will be the US dollar yields, US dollar bonds and treasuries will be a bit more lucrative in that sense for carry trading, right? So this will cause the US dollar to kind of have a little bit of strength over here. So really curious on this. And of course, 29th January is a little bit more mixed. You can see that 20% stay and only an 80% probability that interest rates will be cut in January. And if you have followed this CME, so if you like fundamentals, I do recommend looking at this at least once every 2 weeks. Because if you have seen this in the last couple of months, it was actually almost like a 90% probability that interest rates will drop versus a 10% hold, right? So the way these probabilities change does give us an indication of where sentiment is kind of shifting. So in what I do kind of expect to see is, I do kind of expect to see a maintenance or a slight bullishness, continued bullishness in US dollars, because of really a combination of interest rates differentials as well. So I do know that the general sentiment is a lot of, I think the intention of Donald Trump is to kind of say, hey, we want the US dollar to weaken, but it's really hard to find a place where you can actually sell off the US dollar aggressively. So I think a lot of US dollar weakness is really coming from retracement moves. So what I'm looking for is, I'm looking for continued strength in the US dollar, but wait for the retracements first. It will be a volatile time as we trade into December, because prices are going to be choppy, and I'm going to keep a close eye on the bond yields here, because I am curious to see when will the US dollar and the US dollar 10-year yield snap back into correlation, right? So if it does snap back into correlation, it does mean that the dollar will start to weaken a little bit more aggressively to follow the direction of the 10-year yield. So this is the differentials that I'm prepared for. So the only time I would want to sell the US dollar is if the correlation is broken. All right, so if the correlation gets back into order, because now it's kind of broken, right? This one is up and this one is down, so it's a broken correlation. I want to see, will this be the start of a back into correlation dollar yen situation, and then I will be a bit more interested then in a bit more aggressively shorting the dollar. All right, but not for now. So I think dollar yen is a very nice indication of where the potential dollar strength might go. Now, if we talk about dollar Sing again, for those of you who have been following me the last couple of months, we have been, I hope you guys have at least been conservatively riding the dollar Sing move. All right, so dollar Sing is over here. All right, it's holding strong at 1.30. My target is about 1.32. I don't know if we'll reach there by the end of the year, so I would suggest take profits and let's wait to see if we can get in on those further retracements. Now, how is the Singapore economy doing? For those of you Singaporeans, you kind of need to know this because you live there. Singapore dollar is doing pretty good because the government is still saying the economy is doing well. But if you kind of look at the data coming up, the Sing dollar is kind of going to soften as we enter in 2026. All right, so again, it might change depending on what the government does, but I do expect a slight softness in the Sing dollar. So with the softness in the Sing dollar and the continued potential bullishness on the US dollar, I do suspect we might be able to have an opportunity to take dollar Sing further to the upside, but I would prefer to take it upon retracement. It's a bit high right now. Maybe a 130 will be a good time to buy. If price can break below and head back towards our 1.29, that's my second area of buys. Now it's a little bit high, and if you're trading the dollar Sing, keep an eye on the swaps. Positive swaps on the upside for JDR securities. If you're trading another broker, please be careful of those. And finally, let's take a look at pound yen. Also what Lloyd has mentioned. Now, I do like the pound in that sense because the pound is actually something of a risk-on currency in terms of sentiment. So if you're looking at pound yields, the interest rates is kind of higher as well comparatively to the rest of the economy. So pound interest rates is currently at about 4%, which is exactly the same as the US at this point. So also very good for carry trades. So pound yen would be interesting because if the Japanese yen does not increase interest rates, then after this retracement on the daily, I do potentially see a break towards the upside. So again, I'm also bullish on pound yen, but I do want to catch those potential levels. If you look at the pound yen on the weekly time frame, all right, we are heading into a previous high over here. So comfortably, I will want to see pound yen break the previous high and then retest to the top. But of course, like I think as Lloyd has mentioned in his video as well, we could probably trade shorter time frame breakouts towards the upside. But it's not so much of a strong trend at the moment because we are reaching an area of potential consolidation. But pound yen is definitely something I'm looking at. Last one, we look at oil. Oil is interesting because price has retraced quite greatly. Let's see, where is my oil over here? Now, oil has retraced quite a little bit. I think this is the one. All right, so prices that I like to buy oil would be at 55, which is looks like it's approaching. 55 is broken through 60. We do not have on a weekly time frame. This is a weekly chart. Weekly time frame, I don't see any bullish price action, which is good, meaning that we do have probability of oil maybe retracing a bit further. This is the daily time frame. So I would say a nice demand zone over here at the end of the year. And as we go into January, I think as we go into January, oil tends to be seasonally a little bit bullish as well. But I do prefer to catch oil prices at a nice level. Do be careful though, there is news coming out that Ukraine says they might want to cease fire with Russia. But again, every few months they do release that in the news. So let's see whether or not that really comes to fruition, because if that really comes to fruition, we might see oil prices drop a little bit further in terms of a knee-jerk reaction. But if you look at the entire chart on an overall basis, the orange color vertical line here was the start of this line is the start of the Russia-Ukraine war. So what we're seeing now actually so-called pre-conflict prices of oil have gone into this area. Ignoring this part because this is the COVID area. So ignoring this part, I would say lowest it will potentially go to if Russia and Ukraine stops fighting would be maybe $50 before buyers think it's cheap and purchase off at this very strong technical level again. All right, so this is the reason, these are the levels that I'm looking at, minusing the COVID period. If price can break below 55, then my second buy area will be 50. If price can revisit 55, 56, only enter if there's a technical signal. So we do want a bit of sharper entries. And of course, depending on your broker as well, I prefer to buy a hold because of the positive swaps. If there's no positive swaps, then purely just trade it in and out. So that's all I have this week. Thank you guys for joining me and hope to see you guys. We're coming to December. Please trade safe. hedge fund managers are rebalancing their portfolios. You will see choppiness in the market. You see a lot of pullbacks in the market because everybody is closing their books for say, right? So for you guys also do manage your risks with the understanding that the November, December volume will lighten a little bit and markets tend to get a little bit choppier in that sense. So trade safe and keep those risk management tights. And I'll see you guys